Hi everyone, it's David Pryor again from Priority Funding and Forward Funding. Today in our frequently asked questions video, we're looking at the advantages and disadvantages of an unsecured loan or a line of credit slash overdraft. So let's get right into it. The advantages of a line of credit product. Well, let's look at a line of credit product first. What it means is it's loosely like an overdraft. Okay, so you get approved for $100,000. The $100,000 sits within the funder's profile and within their system. You draw out $20,000 into your bank account. Okay, from day one, in that example, you're paying interest on 20,000, not on 100,000, because you're only using 20,000 at the moment. Then, the next few days, you may pay $5,000 back in as you have cash flow coming in and out all the time. So today you pull out 20,000. Tomorrow you pay back 5,000. From tomorrow you're paying interest on 15,000 because that's how much you have outstanding at that time. Okay, so the flexibility within that product is outstanding. It gives you the ability to actually reuse capital and re-leverage your business on a daily basis. The secret, obviously, is to draw what you really need, pay back as much as possible, as quickly as possible, and have that outstanding balance as low as possible at any one stage. Okay, ongoing access to that product is absolutely sensational. Okay, so the lender, as a rule, will amortize their minimum payments over a 2-year period, so a 24-month period. So what that means is your minimum rate repayment might be $5,000 a month, just to pull a number out of the air. And effectively, as long as you might pay the $5,000 back, but then a portion of that might be principal and will be interest as well, you can reuse that money as you pay it back. So you can keep your outstanding amount at 100,000 if you've used the whole 100,000 and keep on paying 5,000 in and out and redraw 5,000 minus the interest component. So it means then that you have the ability to redraw. I hate that example I just gave you though, because essentially I don't want you to draw 100,000 tomorrow and pay 100,000, pay interest on 100,000. I want you to draw 20, as I used the example of, pay back 10, draw 30 because you've got wages and tax and all those sort of things, pay back 25. And you're continually cycling that money, continually rolling it over and paying the minimum amount of interest you can because you're paying back a large amount of principal on a regular basis. Okay, so we'll look at the disadvantages of that product and then we'll move on to the set loan. Okay, so the disadvantages: poor discipline is the biggest problem with this product. If you are not disciplined enough to actually pay back large portions of the principal as you can and keep that principal as low as possible, you're actually putting yourself up to fail. If you're always owing the maximum amount and just rolling out that on a monthly basis, then you're in debt to your eyeballs, and that's not a good thing. Okay, even the set and forget loan, the unsecured set and forget, has a term that it reduces down to 0. This can stay high, but you can reuse your money. But you've got to be disciplined to pay it back. Generally, it has a slightly higher interest rate than the unsecured set and forget loan, simply because you're accessing money and you're rolling money on a regular basis. The higher interest rate is totally offset by paying principal back as quickly as possible, because then you're only paying interest on a lower amount, not the full amount from day one. Okay. Because you've got the higher interest rate, you're relying on higher cost of funds facilities. Okay. But again, like a normal overdraft within a home, you use it, you pay it back. This facility, you use it, you pay it back. Be disciplined with it as much as you can. Now let's look at what I like to loosely call the set and forget loan. Okay, so this is the one where we get $100,000 and we've got $100,000 of the bills that we have to pay now. So the funder will deposit $100,000 into your account tomorrow. Okay, that means then there are 24 months worth of payments, whether you pay weekly or monthly, and it's set at a set figure. Okay, that might be $4,000 a month, $5,000 a month, whatever it may be, and that's how much it is every single month until day dot, until it finishes over the 24-month or 36-month or whatever the term is. It's amortized down to finish. Um, Generally, you cannot redraw against this facility. You can't at all, actually. But after 6 months, you can apply again to actually extend again. The lender will look at your conduct and say, yes, you can do so. But it's a lot more stringent than the product. But let's look at the advantages again. So it's a fixed amount. You get the set sum, and your payments are set in stone. Okay, it's easy to budget. Okay. It's easy to cost your jobs. It's easy to budget your jobs and your normal budgeting within a weekly and monthly basis, because you know that's the amount that's going to be direct debit out of your account every single month. Okay. These facilities, both of them, are based on your monthly turnover as the main protocol of how they do the credit. So if you're turning over $100,000 a month, you will get 100 or maybe a little bit more depending on your industry. But essentially, it is an amount based on your monthly turnover. Okay, now let's look at the disadvantages compared to your overdraft. It is less flexible. As I said, you get the money in your bank, you get your payments, and there's no flexibility with that. You don't get much benefit in repaying it early. As I mentioned in a different video, you can get some interest rebate, but not full interest rebate. So it has its need, and some funders will err on the side of caution. They may give you a set and forget unsecured loan first instead of an overdraft, because it is easier for them to manage as well. Okay. And the other big disadvantage is from day one, if you borrow $100,000, your interest, which is fairly high because it's unsecured and not secured against property or equipment or anything like that, your interest is on the full amount on a daily basis, reducing as you pay back that loan on a set figure. So the interest today would be $100,000. If you make a $5,000 payment in after month one, you got $95,000 plus the interest. So you might owe $96,500. Month three, be $90,000 plus the 1.5 plus another 1 and 0.25 or whatever it may be. You are paying a larger portion of interest every month because you're only paying on the amount as it diminishes on a month-to-month basis, not on a daily basis as the unsecured overdraft facility can have. That is the main advantages and disadvantages of those two products. They are fantastic for cash flow if you use them properly. I do a lot of transactions where we do a mixture of a set and forget, where it's easy to budget, but we also do part overdraft, which allows them to redraw when they need to. Products are fantastic for the future, and we'll talk about a few other products similar to these that provide you with cash flow against maybe invoicing or other facilities within the business as we move forward. Thank you for watching the video today. It's David Pryor from Priority Funding and Forward Funding.